Ever wondered how to start investing? Well, investing is the golden key to financial growth, a path to building wealth over time. It's about putting your money to work today so it can multiply for tomorrow. This video is your treasure map, designed to navigate you through the seemingly complex world of investing. We'll break it down into simple, easy-to-understand steps, guiding you from the basics right through to making your first investment. So, are you ready? Let's dive into the world of investing. First things first, what exactly is investing? Well, investing, in its purest sense, is the act of allocating resources, typically money, into something today, with the expectation that it will generate more resources in the future. It's a calculated move to grow your wealth over time. Imagine you have a tiny seed, you plant it, care for it, and over time, it grows into a tree that bears fruit. That's investing. You're planting your money in different soil or investment vehicles, nurturing it, and eventually it bears fruit or returns. Some of the most common types of investments include stocks, which represent ownership in a company, bonds, which are essentially loans you give to the government or a corporation, and real estate, which involves buying property. There are many more, but these are a good starting point. Now that we have a basic understanding of what investing is, we can move on to the next step. So why should you consider investing your money? Well, let's dive into the benefits. Firstly, investing is a powerful tool for wealth creation. It allows your money to work for you, multiplying over time. Imagine planting a seed and watching it grow into a fruitful tree. That's what investing does to your money. Secondly, investing can generate an additional income stream. Dividends from stocks, interest from bonds, or rent from real estate can add a nice padding to your wallet. Thirdly, investing helps in saving for retirement. By growing a nest egg, you can ensure a comfortable and secure life in your golden years. Lastly, investing helps beat inflation. If you just let your money sit in a savings account, its value decreases over time due to inflation, but investments, particularly those in the stock market, tend to outpace inflation. Investing can lead you to financial freedom, but remember, investing has its benefits, but it's not without its risks. Understanding risk is a crucial part of the investment process. Investing is not just about making profits, it's about managing uncertainty and making informed decisions. Now let's dive into the concept of risk. Firstly, risk in investing essentially refers to the possibility of an investor experiencing losses due to factors that affect the overall performance of the financial markets. And these factors come in many forms. One of the most common types of risk is market risk, also known as systematic risk. This is the risk that comes with any investment and is tied to the overall performance of the market. If the market takes a downturn, it's likely that most of your investments will too, regardless of the individual strengths of your holdings. Next, we have inflation risk. This is the risk that the return on an investment will not keep up with inflation, thereby reducing the purchasing power of the money invested. For example, if the inflation rate is 3%, your investment needs to grow by at least 3% just to maintain its current value. Then there's liquidity risk. This is the risk that you won't be able to sell an investment when you want to. If there aren't enough buyers in the market, you may be forced to sell at a lower price than you'd like, or you might not be able to sell at all. Now, understanding these risks is one thing, but how you react to them is another. That's where risk tolerance comes in. Risk tolerance refers to the amount of risk you're comfortable taking on. It's important because it helps shape your investment strategy. If you have a high risk tolerance, you might be comfortable investing in riskier assets for the potential of higher returns. On the other hand, if you have a low risk tolerance, you might prefer safer investments, even if they offer lower returns. Risk is a part of investing, but it's not something to fear if managed correctly. By understanding the different types of risk and your own risk tolerance, you can make informed decisions and create a balanced investment strategy that aligns with your financial goals and comfort level. Ready to get started with investing? Fantastic! Let's break it down into manageable steps. First things first, set your financial goals. Are you saving for a new car, a dream vacation, or a comfortable retirement? Your goals will shape your investment strategy. You might go for high-growth stocks if you're young and saving for retirement, or safer bonds if you're closer to your goal. Next, you'll want to choose the right investment account. Different accounts offer different tax advantages. If you're saving for retirement, consider an individual retirement account or IRA. If you're just starting a general investment fund, a standard brokerage account might be the way to go. Remember, it's not about picking the best account, it's about picking the one that best suits your needs. Now let's talk risk. Understanding your risk tolerance is crucial. All investments come with some level of risk. Typically, the higher the potential return, the higher the risk. If the thought of losing money keeps you up at night, you might want to stick to lower risk investments. If you're okay with some ups and downs in the pursuit of potentially higher returns, you might be more open to riskier investments. Diversification is your next step. Don't put all your eggs in one basket. Spread your investments across a variety of asset classes: stocks, bonds, real estate, and more. This can help protect you from volatility in any one area. The final step: regularly review your investment strategy. The market changes, and so do your financial goals and circumstances. Make a habit of checking in on your investments at least once a year. Review your portfolio's performance, reassess your financial goals, and adjust your strategy as needed. And just like that, you're on your way to becoming an investor. As a beginner, it's easy to make mistakes, but don't worry, we've got you covered. Stepping into the world of investing can feel like navigating a labyrinth. There are plenty of pitfalls, and even the most seasoned investors can stumble. However, being aware of common mistakes can help you avoid them. And today, we'll explore 4 of these errors that beginners often make. First up, not diversifying. Imagine putting all your eggs in one basket and then accidentally dropping that basket. Ouch! In investing, this basket represents a single investment or asset class. If that one investment doesn't perform well, your entire portfolio suffers. To avoid this, spread your investments across different asset classes like stocks, bonds, real estate, and more. This way, if one area underperforms, the others can help balance out your portfolio. Next, investing without a plan. While spontaneity can be exciting, it's not the best approach to investing. A solid plan guides your investment decisions and helps maintain focus on your financial goals. So before you dive in, determine your risk tolerance, financial objectives, and investment timeline. Thirdly, letting emotions control investing decisions. It's easy to get swept up in the market's ups and downs, but remember, investing is not about emotional reactions but calculated decisions. Fear and greed can be powerful, but don't let them dictate your actions. Stick to your plan, stay patient, and remember that investing is a marathon, not a sprint. Lastly, not investing for the long term. Sure, it's tempting to seek quick wins, but investing is not a get-rich-quick scheme. It's about building wealth over time. So resist the urge to jump in and out of investments based on short-term market fluctuations. Instead, focus on long-term growth and compound interest. Avoiding these common mistakes will set you on the path to successful investing. Remember, everyone makes mistakes, but being aware of them is half the battle won. So keep learning, stay disciplined, and happy investing. Investing can seem daunting at first, but with knowledge and practice, it becomes second nature. We've taken you through a journey today, demystifying what investing is all about. We've looked at the why behind investing, and we've delved into the concept of risk, understanding that while it is inherent, there are ways to manage it effectively. We've also given you a step-by-step guide on how to start investing. From setting clear and achievable financial goals to understanding your risk tolerance and choosing the right investment platform, we've covered it all. Remember, there's no one-size-fits-all approach here. Your investment journey will be as unique as you are. We've also discussed some common pitfalls that beginner investors often fall into. The key takeaway? Stay informed, be patient, and never let emotions dictate your investment decisions. So, where do we go from here? The answer is simple. It's time for you to start your investing journey. There's no better time than the present. Don't wait for the perfect moment to invest, because in reality it doesn't exist. The secret lies in getting started and staying consistent. Remember, the journey of 1,000 miles begins with a single step. Your investing journey begins today.